Hello and welcome back to Swing Trading Masterclass by Wealthy Education. In this video, we'll talk about exponential moving averages. Exponential moving averages are some of the most basic indicators out there. They are used in a ton of systems. An exponential moving average is just a moving average, and a moving average is the average price, typically the close of the last X amount of candles. So what happens is you get a bunch of dots on a chart like this, and let's just say your moving average is 20. So this is the average of the last 20 candlesticks, typically the closing price. As we move up, then it'll be the average of the last 20 candlesticks, knocking the last one off of the previous one. It gets connected, and it ends up being a line. So let's go ahead and take a look at what this looks like. So we click on our indicators as usual, type in moving, so moving average exponential. I'll put a couple on the chart. And you can see that you can change it. So I'll use two common ones here, 9 and 20. They're two different colors. So blue is where you're here, right here, is the average price or the average closing price of the last 9 candlesticks. And this is the last 20. The idea is that the average price of the last 9 candlesticks will give you a much quicker reaction than 20. So this shows short-term momentum. It shows the trend. You can see that the trend is definitely higher. We are starting to flatten out on both moving averages, though, so that shows that maybe we're starting to roll over again, or at least take a pause. There are multiple common moving averages. 200 is a big one for longer-term traders, and notice how that shifts, because it takes more to move the average. Moving up one candlestick is only 1/200th, or 0.5% of the calculation. So you need to see much bigger moves over the course of several candlesticks to move this. So a lot of traders will look at this as your long-term indicator. Notice how it's resistance and support when it is sloped. When it's sideways, there is a reaction, but it becomes a lot less crucial, if you will. Let's go ahead and move this to 50. And you can see the 50 a little bit quicker to respond. Resistance, support, choppiness, a little bit of resistance, and so on. Moving averages are not the be-all, end-all of indicators, but they do give you an idea as to how the market itself is behaving. Sometimes you will see just one indicator on, so in this case, like the 50-day EMA, but others will have two, like that. And there is such thing as a moving average crossover, which is when the quicker of the moving averages crosses over the slower. That is the beginning of a new uptrend for a lot of people. Some people will simply buy here, sell here, buy here, sell here, buy here, etc. Just buy as it breaks above, sell as it breaks below, buy as it breaks above, sell as it breaks below, and buy again. That's a little dangerous because you get times like this where you get chopped up. The farther the spread, the more likely it is to be a strong trend, because the short-term buying or selling is much quicker than the longer term. So it means that we're accelerating in one direction or another. Now, you can take a look at the daily chart, but here on the hourly chart, you would more than likely use some of the shorter moving averages. So, for example, this is a 9 moving average, 9 hours. You can see it tends to hug the hourly candlesticks pretty well. And 20 is one that's commonly used. That's the orange one. So let's take the 9 out. And you can see how it does offer nice support and resistance most of the time when it's sloping. Again, there's going to be times where we chop around like that. There's just no way around it. You'll learn candlestick patterns and other indicators that can go along with this to kind of smooth some of this out. But typically the moving average is a secondary indicator. So And you'll learn this later, but this is a candlestick that you would be interested in buying. There's a gap here. You rally, you pull back, and you see strength again. And at this point, the 20 hourly EMA is sitting there trying to offer support. That was a nice buying opportunity. So that's one way that it's used. On the other hand, if you get a buy signal that goes against the moving average, or a sell signal that goes against the moving average, breaking down below this candlestick here could have been a sell signal of sorts. It's called a hanging man, but it's against the moving average. So a lot of traders would wait until that moving average was broken to confirm that we had changed trend. Over here in dollar Swiss, I'll bring it down to 15-minute chart. And I will use the 10 and the 20 because that tends to be a pretty common day trading moving average. You can see the farther we spread, the more likely we are to make profits following the crossover. So once we had this pretty big crossover move, we started to spread out and rally. This type of sideways action, you just ignore it. You don't get bothered with it. It tells you the market isn't ready to do anything. We broke down below, and then by the time you got to this candlestick, we started to spread out again. That was a sign that we were ready to continue. Again, you're going to look for other reasons to be in and out of the market, but this is just a handy little tool that people will take advantage of. From various pundits, you will hear the term golden cross or death cross. Honestly, it's something that you should probably be aware of, but most of the time it doesn't work, and I'll show you an example as to why. So the golden cross is when the 50-day EMA breaks above the 200-day EMA. Some people will tell you that it's anytime that happens on any time frame. That's not true. It's a daily signal only. This is where it happens, and the idea is that it begins a pretty strong uptrend. The problem that you're going to run into with this is that, you get in right here. You're a buyer there. And notice how bad of a pullback you had to sustain before you got a sell signal, which would be the exact opposite. You clearly would have gotten stopped out if you used any type of common sense. But assuming that you didn't, and you simply follow it until it crosses again, well, you get out here, which is at this candlestick. Congratulations, you just lost money. You got in here, you got out there, and probably even more distressing is you sat on the market for about 6 months to lose that money when you were up several handles. You were up 4 handles at one point. Death cross. 50-day EMA breaks down below the 200-day EMA. So you lost your money on this trade, so you figure, okay, well, the trend's changing. Obviously, I should short it here. You short it there. And then what happens is you get out at the golden cross up here. Congratulations, you just lost almost the exact same amount of money in roughly the same time. So I would highly recommend ignoring these signals. Now, it's not that they can't work, but they're not the signal in and of itself. And that's a huge mistake that a lot of retail traders make. Like, look at this massive run in Bitcoin. You would have gotten in somewhere around here, and you would have gotten out here. In true, you would have made money, but look at everything you left off the table here. So there are other ways to trade this. Typically, when you see a golden cross or a death cross, it's something worth paying attention to, but it's worth paying attention to on a smaller time frame. So you see it on the daily chart, and then you start looking for setups in that direction. Because clearly, you could have used hundreds of different reasons to get out of the market. Once we hit 14,000, if you get in at 5,500, you have to kind of wonder how much further it can go straight up in the air. So that is one of the major weaknesses of using that. Typically, traders look for a reason to pay attention to these moving averages and then use them as confirmation. We will get into the candlesticks and the moving averages working together, the trading patterns and the other indicators working together with the moving averages. But right now, we just need to understand what they actually are and what they tell us.